I'm Phil Borkin from JBWere's Investment Strategy Group. When we think about some of the key features of this economic cycle post the financial crisis, a few things spring to mind. Pretty modest economic growth, low inflation, unprecedented levels of central bank stimulus, and probably most remarkably is the dramatic fall in government bond yields. Now, I certainly don't have time in this video to go through kind of all the reasons why we've seen these observations, but certainly they've had a dramatic impact on the way markets and investors have behaved over the same period. So think of fixed income markets, for example. These low government bond yields have driven a rabid hunt for yield, which has seen credit spreads compressed to historically tight levels. In equities, low bond yields have had an impact too, but it's been slightly different. Perhaps it's more a reflection of the fact that economic growth has been so low that investors have been looking for and willing to pay for any companies that have offered growth, particularly those with stable earnings and strong balance sheets. Now, these companies are typically in your more defensive parts of an economy. It's those that are less sensitive to the economic cycle. So in the US, think of the tech sector, for example, while in Europe, it's more around consumer staples. And they also has typically benefited, although not necessarily, from lower bond yields as well. Now, where investors haven't had the demand has been in your value or your cyclical type companies. These are companies that are more sensitive to the economic cycle and, importantly, more exposed to downside risks. And your good example here is your financials. But this growth versus value type outperformance has been the strongest it's been since the 1970s when you look across all global equities. And in many markets now, the valuation premium that these companies have over value companies is the highest on record. So at some point we will see a rotation. At some point value will start to outperform again. The trick, of course, is knowing when that will be and what the catalyst will be. Interestingly, at the start of this month, we did get a hint of what that could entail. Some slightly better economic data, at least relative to low expectations, as well as some modestly better trade headlines, saw bond yields spike higher and growth start to underperform value. It actually started to raise a lot of speculation about whether this is the start of that great rotation. But it wasn't sustained and looks more like a positioning squeeze than anything else. For us to see a sustained move into value and out of growth, we really need to see three things. A pickup in growth and growth expectations, a sustained lift in bond yields, which no doubt would require central banks to start tightening policy and not easing like they are at the moment, and a reduction in policy uncertainty. Look, at the moment, it's pretty hard to envisage any of those things really. And so for us, it looks more like the status quo will continue. And perhaps this great rotation into value and out of growth may not even happen until the next economic cycle. I'll leave it there, but of course, as always, if you have any questions, please reach out to your JBWere advisor.